low-cost investments can significantly enhance your overall returns, and fees, we know over the long run, really eat into your gains, making it harder to achieve your goals without taking additional risk in your portfolio. Hey, this is Chris from StockSpot, and in this video, I'm going to be sharing my 5 tips for generating income in a portfolio in an environment of higher inflation and higher interest rates, which is what we're seeing at the moment. And my tip number 1 is make sure you diversify to reduce your concentration risk. Now, diversification is a fundamental strategy to reduce risk in a portfolio. And while higher dividend paying shares and other asset classes can provide more yield, they often come with less diversification. Higher dividend funds tend to be overweight defensive sectors like consumer staples, healthcare and utilities, and underweight other sectors like consumer discretionary and technology. And they also tend to be more concentrated within the top 10 holdings. So with this in mind, it's important not to be too heavily focused in sectors which pay high dividends, but can lead to more risk within a portfolio in an environment, particularly of higher interest rates and inflation. And this is the reason why for our clients, in the high dividend paying share space in Australia at least, we recommend the Vanguard High Yield ETF. Because while it does have a higher exposure to some sectors like financials, it's also balanced with a higher exposure to energy and materials, which are sectors that tend to do better in an environment of higher interest rates and inflation. So it's balanced out quite nicely. My tip number 2 is to include some interest rate and inflation protection in your portfolio if you're focused on income. Now, as interest rates rise, high dividend paying shares and bonds with high yields tend to become relatively less attractive, which potentially leads to price declines in the capital. So to offset this risk in your portfolio, it's important to have some level of inflation protected assets in order to give you a nice balanced outcome over the long run. So some examples of assets that you could include in an income focused portfolio that give a bit more inflation and interest rate protection include investments like resource shares. And we recommend to clients the ETF OZR, which is a resource share focused ETF, which has a big exposure to commodity producing companies that produce oil, metals, and materials. And this can act as a good hedge against inflation and interest rate risk. And the other one that we have in our core portfolios, and we have in all of our portfolios, in fact, is gold. So gold is a classic hedge against inflation and interest rate risk, as well as political risk. And even if you're focused on income in your portfolio, I would be suggesting that gold could be a good component of that portfolio, even though it doesn't generate any income itself, because it helps to balance out your overall portfolio risk. And by incorporating these assets into your portfolio, you can potentially reduce the negative impact of rising inflation and interest rates on your returns. My tip number 3 would be stick with low costs and simplicity. So low cost investments can significantly enhance your overall returns. And fees, we know over the long run, really eat into your gains, making it harder to achieve your goals without taking additional risk in your portfolio. So studies, and there's been plenty of them, consistently show that low-cost funds like ETFs tend to outperform high-cost counterparts. And they outperform largely over the long run due to their fees and the fact that more of your capital stays with you rather than getting paid to the financial industry. So for asset classes that people are looking for to generate income, and I would say property and infrastructure, as well as bonds, corporate bonds and inflation protected bonds. A lot of these offer very expensive unlisted products that might charge fees of 1 or 2% per year plus performance fees. My tip would be avoid those riskier products that are unlisted, illiquid, hard to really get transparency on, and have much higher fees, and stick with the listed equivalents where their fees are very low. So there are some great ETFs out there following those asset classes: property, infrastructure, inflation bonds, corporate bonds, with fees as low as 0.2% per year. That's going to allow more of your savings to stay in your pocket every year and to see your returns compound over the years. So with income generation, stick with low fee products. My tip number 4 would be don't just blindly chase yields. So these days, particularly as interest rates are rising, I'm seeing lots of ads in the paper, online, advertise high yield investments that pay what looks to be very high returns of 8 or 9 or 12% per year. Keep in mind that high dividend returns or high income returns always inevitably come with higher risk. And that risk could be the preservation of your capital not being prioritized, or it could be counterparty risk, or it could be other risks. You need to be aware of these risks, and I'd say blindly chasing income can lead to disastrous results. And with high income usually comes high risk. And so make sure that you have a diversified mix of assets in there, but also appreciate that it's not always possible to generate high income without high risk. And you may need to accept slightly lower income, but the protection and preservation of your capital as a more important priority in your portfolio. And that brings me to my fifth and final tip, which is be mindful of tax implications. Now, particularly for income investors that are in taxable accounts, so people that aren't in the drawdown phases of their super, need to be mindful of the impact of tax on your returns. So if you're using an income-focused approach, you may find that it generally attracts higher taxes because income is taxed at a higher rate in Australia for most people compared to long-term capital gains, particularly once you attract the 12-month capital gains discount. You need to really consider your tax implications as well as risk tolerance when planning your income investment strategy. And I would be really considering both the implications of tax on the income, but also the turnover of your portfolio if you're using more active strategies to consider the tax consequences and really think about the after-tax returns that you're earning rather than the pre-tax returns, particularly for income portfolios. So they're my 5 tips. And in conclusion, I think dividend or income investing in Australia can be a really rewarding strategy, but it's important to follow a few important tips, I would say, in order to maximize your potential for great long-term returns. You need to diversify, protect your capital against inflation and interest rate increases, keep your fees low, avoid blindly chasing yield for the sake of it, and consider after-tax consequences of investing. And I think by following these 5 tips, you can create a really well-balanced and resilient dividend or income portfolio that serves your long-term goals and allows you to achieve long-term investing success. So thanks for watching my video. I'd love to hear any comments or tips you have for income investing in the comment section.